Assalamualikum warahmatullahi wabarakatuhu. Innal hamdanillah wassalatu wassalamu ala rasulillah. Amma ba'd. Bismillahirrahmanirrahim. This is Muhammad Kamrul Hussain, Department of Business Administration, Metropolitan University, Sylhet. Welcome to my virtual classroom, MKA Classroom. Now let's start today's video tutorial. Today we will try to discuss a very important topic, that is principles of insurance. As a student of business administration, you have to have idea about insurance. In here we will try to develop the basic ideas of insurance. Some of you in future are going to doing business, then you need insurance for your business. Or someone is going to jobs, then also you need insurance, that is life insurance for your life and your family life. That's why the concept of insurance actually is important for us. In this topic, we only try to discuss several principles. After that, we will try to discuss types of insurance, etc., etc. So now our today's topic is principles of insurance. Here we will try to discuss what is insurance, several terms used in insurance, types of insurance company, who may be insured, and may try to develop only basic idea life insurance or property insurance. And lastly, we will see some legal aspect of insurance contract. Some legal aspects of insurance contract. These are we will discuss in here. Now first we will try to discuss insurance. What is insurance? Actually, insurance is a contract whereby a party transfer his risks or risks of financial losses to the other party. That means insurance is a mechanism of transferring risks one party to another party. So in the insurance contract, that is a contract here related to parties. One is insurer and another party is insured. The person who purchases the insurance policy is called insured and the company is called insurer. So insurance means insured person may transfer his financial risks to the insurance company for a premium or for some amount of fund. The insured person can transfer his financial loss to the insurance company. If losses happened for the desired causes, then insured can get fund from the insurance companies. As a result, the financial loss is covered. Actually, at last, the insured has no any kind of financial loss. That's why it is called a mechanism. Insurance is called a fund risk transfer mechanism. Risk transfer mechanism. In here, we use several terms for the better understanding of insurance. We will use several terms: insurer, insured, beneficiary, policy, phase, premium. The several terms we are using in insurance. First one, insurer. Insurer means the company writing the insurance. The company writing the insurance is called the insurer. It means who take the risks of other parties, he is the insurer. Who takes the risks of other parties is called the insurer. And insured, the person who is protected against the financial losses, or you can call the person who sells his risks to the insurance companies. He is called insured. He is called insured. Later on, we will see beneficiary. Beneficiary, the person who receives proceeds of life insurance. So beneficiary actually is related to the life insurance. As like the death of a person, then fund will provide to his heirs, his children or his wife. His children or his wife is called then beneficiary. The person who receives proceeds of life insurance, he is beneficiary. Later on, we will see policy. Policy actually it is the written document or written contract of insurance. That is the policy. So obviously insurance company has the policy and written document. We have learned that the written agreement. So this written agreement actually is called the policy. There has note down all types of terms and conditions in this policy. So whenever you purchase insurance policy, then you have to read and understand all the topics included in this policy. That's why policy is too much important for us who is going to purchase insurance policy. Later on we will see phase. The maximum amount that the insurer agrees to pay in case of a loss is known as phase of the policy. Phase of the policy. Maximum insurer pays for loss. Maximum amount that the insurer agrees to pay in the case of loss is known as phase of the policy. Suppose you were going to purchase a insurance policy from a insurance company for your business, and the total cost of your business is like 1 crore taka. If it is damaged, all is damaged or fired, all of your property, then you will get only the face amount. That means maximum amount that will insurance company will provide you. That is the face amount. That means whenever you purchase your policy, insurance company can tell you that if your whole business is damaged, I will provide you 80 lakh taka. Then that 80 lakh taka actually is called the face of the policy. That means that is the maximum amount that are going to provide you by the insurance company. And lastly, premium. The consideration the insured pays for protection is called premium. That is a consideration paid by the insured. Premium, that means you can provide it by the life insurance yearly basis, that is premium. A lump sum amount you are going to pay to the insurance company for your risks. That means you are transfer your risks to the insurance company. As a result, you have to pay some amount to the insurance companies. So that amount is called premium. Life insurance, for the life insurance, that premium is continue for several years. It may be premium provided by monthly or yearly or semi-annually basis. But except life insurance, walls insurance or property insurance, for the property insurance, this premium is provided by a single time in a year. Walls policy maturity period are in 1 year except life insurance. So you have to provide premium for 1 year for the property insurance. But life insurance, this amount you can provide, this premium can be provided by semi-annually, monthly or yearly basis for continue for 10 years or 20 years or whatever, whenever you die. That is the premium. Later on we will see risks or peril, danger of losses. Danger of losses. Danger of a loss or injury to property, life, or anything else is called risk or peril. And it is related to the hazard. When danger may be covered by insurance, it is known as the insurable risks. Insurable risks, here is another important thing, insurable risks. Insurable risks has the several types. So if the risk is covered by the insurance company, that is called the insurable risks. Factors such as fire, floods, which contribute to the uncertainty are called hazards. That means factors that contribute to uncertainty. It means cause of risks is called hazard. The causes of risks is called hazard. Causes of risks called hazard. Then rider. Addition to insurance policy that modifies, extends, or limits base contract. A rider on an insurance policy is a clause or even a whole contract add to the another contract to modify, extend, or limit the base contract. A rider must be clearly incorporated in, attached to, or referred to the policy so that there is no doubt the parties wanted to become a part of policy. Binder, temporarily contract of insurance. Frequently, an individual needs insurance coverage immediately or before an insurer can issue a formal policy. Insurance agents customarily have the authority to issue a binder or a temporary contract of insurance until the company investigates the risks and issues a formal policy. So that is the binder, that is a temporary contract. That means whenever insurance company take your risks, that means sells their policy, or whenever you purchase the insurance policy, there has a responsibility of insurance company to judge your risk factors. There has the several risk factors, so that should be thought, or that should be modified, or that should be justified by the insurance companies. Now we will see types of insurance companies. So basically two types of insurance companies: stock companies and mutual companies. A stock insurance company is a corporation for which original investment was made by stockholders and whose board of directors conducts its business. That is the stock companies. As in all other corporations, the stockholders elect the board of directors and receive the profits as dividend. Unlike other corporations, insurance companies must place a major protection of their original capital in a reserve account so claims can be paid. That is the interesting thing for insurance companies. They have reserve of capital for claim, that sometimes they have to pay that amount. As business volume increases, companies must increase the reserve by setting aside part of the premiums into this account. That is the stock companies. And mutual companies, company of policyholders in investors. In a mutual company, the policyholders are the members and owners and correspondent to stockholders in a stock company. So in here, mutual companies, here the policy purchaser and policy sellers are the owners of these companies. That is the mutual companies. But stock companies, here are the different investors and policy purchaser are different, but in mutual companies they are same persons. Then later on we will see who may be insured. That means who can purchase the insurance policy. It is very simple, we know that. The person who has a contract capacity, he can purchase the insurance policy. Obviously, he or she have to financial solvency to purchase this policy. Here is a one condition. First conditions, he or she have to be ability of contract, and second condition, he or she has to financial solvency. If he has a ability to contract but has not the financial solvency or has not sufficient fund to purchase the insurance policy, then he may not be insured. So obviously he or she have the financial solvency to purchase the insurance policy as well as the contract capacity. That means in a sound mind, more than 18 years old, and financial solvent. These people can purchase the insurance policy and become insured. And here has another things you have to note down, that insurable interest. Insurable interest. Insurable interest. If the insured person has not any kind of insurable interest for that matters, then he or she cannot be insured. Here is the important thing, that insurable interest. Insurable interest is the financial relation with the matters. That means whenever you purchase insurance policy for your motorcycle, then you have a insurable interest with you and your motorcycle, because if it is damaged or if it is destroyed, then you are financially loser. That type of interest or relation is financial relations. If your car or motorcycle is well, then you have no financial loss, but if it is destroyed or damaged, you face several financial losses. So insurable interest is that matters which shows the financial relation. So interest in
non-occurrence of risks incurred against. So these should have to purchase insurance policy for the insured. So the person who purchases the insurance policy, he must have insurable interest for that matters. As like if you purchase your life insurance policy, then you have a insurable interest with your wives or with your children, because if you die, then your family have become financial losers. That's why there has a insurable interest with you and your family. So if you are going to be insured, then you have must insurable interest in this matter. So all types of insurance are basically two types: life insurance and property insurance. Life insurance is relating matters of life. It is for your life or your wife's life or your children's lives. So you have a insurable interest to your life, to you and your wife, because if your wife is died, then you will face several financial losses. That's why you can purchase insurance policy for your wife's life. That is the life insurance contract of insurer to pay money on death of insured. So in this case, the insurance company will provide you to the required amount for your wife's death, because you will have several financial losses by your wife's death. It's like your wife is prepared for meals for you and your family, and she brought up your children. So if she is absent, then you have to take several maids to maintain or brought up your children, and you have to take several maids for your meal. So this actually is related to the insurable interest. Now property insurance, that is the damage of your property or destroy your property. So it is related actually to the your property. So contract by which insurer pays for damage of your property. It is maybe your car or your home or your motorcycle, etc., etc. All types of property, your business farm is related in this matter. Common types of insurable interest: mortgage, seller, bailiff, partner, tenant. These are the common types of insurable interest. The mortgage has an insurable interest in the property mortgaged to the extent of the mortgage. Seller has an insurable interest in the property sold on the installment plan when the seller retains a security interest in it as a security for the unpaid purchase price. A bailee has an insurable interest in the property bailed to the extent of possible loss. The bailee has a potential loss from two sources: compensations as provided for the contract of bailment might be lost. Second, the bailee may be held legally liable to the owner if the bailee's negligence or the
negligence of the bailey's employees causes the loss. A partner has a insurable interest in the property owned by the firm to the extent of possible loss. A tenant has an insurable interest in the property to the extent of the loss that would be suffered by damage to or distractions of the property. So, a change in the title or possessions of insured property may destroy the insurable interest, which in turn may void the contract, because insurable interest must exist in the time of the loss. That's why a person cannot purchase life insurance policy for the other peoples who is not related to him. So, a person can purchase the insurance policy which has the insurable interest to him. Later on, we will see some legal aspect of insurance contract. That is concealment, false representation, warranty, subrogation, and estoppel. These are the special aspect of insurance contract or a special significance for insurance contract. Concealment. Willful failure to disclose pertinent information, that is the concealment. Whenever you purchase the insurance policy, if you hide the information, then there create the concealment. Representation or false representations or misstatement of the material fact, that is, if you hide the original scene or original fact, that is the false representations. Sometimes we may hide our age, as like if your age is 22, whenever you purchase a insurance policy, you say that your age is 18 or 19. That means you provide the false representation or misstatement to the insurer. So the concealment or false representation can create the insurance contract void. Insurance company sometimes cannot pay your required payment for your demand as insurance. Warranty. A statement of insured that relates to risks appears in the contracts. That means warranty. A statement of insured that relates to risks appears in the contract. That is the warranty. So here is a number of risks, risk factor. So that is the warranty. If you include more risk factor, your premium should be more. Subrogation, right of insurer to assume rights to insured. That means whenever insurer pays you the claim, the insurance company then become the owner of that property. As like we can pay an example for marine insurance. If you purchase your ship insurance, marine insurance, if it is destroyed in the sea, the insurance company will pay you full for your price of ship. Then the insurance company become the owner of that ship which is sunk in the sea. That is the subrogation. And estoppel, one party leads to a second party false conclusions and second party relies on. The second party would be harmed if the
first party were later allowed to show the conclusions to be false. Then in this case, the insurer can reject, or insurer can void the insurance policy. So now we will see in the details the concealment. An insurer must rely on the information supplied by the insured. This places the reasonability of supplying all information pertinent to the risks on the insured. A willful failure to disclose this pertinent information is known as concealment. That means willfully hide the information. Then representation, an oral or written misstatement of a material fact by the insured prior to the finalizations of the contract is called a false representation. If the insured makes a false representation, the insurer may avoid the contract of insurance. This results, whatever or not to the insured made the misstatement purposely. Warranty. A warranty is a statement or promise of the insured that relates to the risks and appears in the contract or another document incorporated in the contract. Untrue statements or unfulfilled promise permit the insurer to declare the policy void. Subrogation. In insurance, subrogation is the right of insurer under certain circumstances to assume the legal rights of or to step into the shoe of the insured. Subrogation particularly applies of some types of automobile insurance. If the insurer pays a claim to the insured under the laws of subrogation, the insurer has a right to any claims that the insured had because of the losses. Estoppel. Neither party to an insurance contract may claim the benefit of a violation of the contract by the other party. Each party is stopped or prevented from claiming the benefit of such violation.
This all about today. Stay home, stay safe, try to maintain a safe social distance. Try to wash your hands frequently in a day. Subhanaka Allahumma wa bihamdika ashhadu an la ilaha illa anta astaghfiruka wa atubu ilaika. Assalamualaikum warahmatullahi wabarakatuhu.